Hi, welcome to Urban Insights. I'm Jayashree Kurup. I have with me Shiv from Hbits. Hbits is a leading fractional ownership platform and it has announced the launch of its new asset in the MMR French listed tech MNC. It is its 16th property and it offers 54.66 crore investment opportunity. And discussing this entire thing with us is Shiv. Shiv, thank you so much for joining us. Shiv, first of all, tell us a little bit about Hbits. When did you start? Which are the geographies you work in?
Yeah, so started this business in 2019. So we launched our first asset at the end of 2019. But just a little bit of context, the where this concept or idea comes from is I saw when I because I'd worked in the real estate industry. And then I'd finished my MBA at Harvard and I got back to India and I was exploring various business concepts and then I saw in the real estate industry, in the commercial real estate industry specifically, once an asset is constructed and rented out, a developer has only a couple of exit options. Either they sell the full building to a large global fund for a few thousand crores, or then they were selling these floors to get an exit to ultra HNI investors for 30, 50, 100 crore. And this was a very attractive investment option. Your large global institutions had made extremely good money in this, investing in these assets because these are long-term assets. Your grade A glass facade buildings, they were rented out to MNC tenants. You had long-term leases, and one could get 8 to 9% rental yield, and along with appreciation, one could make a very stable 15 to 16% IRR. But the biggest issue was that the ticket size was 50, 60, 100 crores. So most people obviously don't have that. So, I thought that why don't we create this platform where people can own a share in the property or a share in the building? Really just creating the stock market for real estate. The way someone can own a share in a Reliance or a Tata stock, why can't someone own a share in a building? So that was effectively the genesis of the idea per se, and that's where we started from. So it's been about a 5 6 year journey now. And in terms of you asked where we are present. So we have assets across Mumbai, Pune, Bangalore. So those are where our properties are present. But we have customers from across the country, right? Tier 1 cities, tier 2 cities, small towns. We also have NRIs who come from across the Middle East, Southeast Asia, Singapore, Europe, Africa, America. So investors are global, to be honest. So that's where we are as of today.
Okay. So when you acquired your first, what was your first property?
Yeah, so first property was obviously a significantly smaller property. That's when we were just starting off the business. It was about a seven odd crore property. So for our first asset, and that time our minimum ticket size was 25 lakh. So to fund that property, we were looking at about 30 odd investors. So obviously we started small because we didn't know what the reception would be. And in fact, when I started, most people, when you ask them what do you get in real estate, what rental you get in real estate, the immediate replies were just 1 2 3%, because that's what you get in residential real estate, and that's what people were familiar with. And when people said no, in real estate you're getting 8 to 9%, the first thought is something is wrong. It's not possible, because they were never offered this product, right, at a 25 lakh ticket size. They were not exposed to it. So when we started, obviously it was very early on. There were just four people in the team, and at that time there's a lot of convincing. We didn't have a brand, so that's kind of initially how we started off.
Okay. And as you acquire more and more properties, what are the things that you look for in a property when you acquire?
I think I think that's the most important thing, right? Because ultimately, your selection criteria is going to determine not only the return that the investor will get, but also the safety of the investment, or the limiting the downside risk. Um, and just a little bit of background. I come from a background where family has been into real estate and real estate development for 35 plus years. So we have a lot of that knowledge that goes into acquiring properties. So firstly, in terms of what we look for, is we take assets or properties that are already only constructed and already rented out. So you don't have any development risk, developer risk, financial risk, approval risk. So all those risks, leasing risk, all those risks are not there. This is an asset building that already exists. You can see it. It's operational. Tenant is already in place, already occupying it, already paying rental. And think about your, in Mumbai, think about your buildings in BKC and Dheri East. In Bangalore, think about your buildings in ORR. In Delhi, say your buildings in Gurgaon. So, and then after that, we obviously look at the building quality. We look at the, micro market, or the neighborhood that the building is present in, how that is doing. We look at the kind of infrastructure development that's happening in that micro market. We look at the tenant profile, right? So we only take MNCs or large Indian corporates. So some of our tenants are Toyota, Microsoft, ICICI Bank. So can't go wrong. Then we look at we look at the reason for the tenant being in that location. Have they been there for a while? Have they done capital capex in that property? Is their employee base from around there? Is there any reason that they'd want to leave, or are they very happy there? What is the logic for that occupier being there? We look at the contract between the tenant and the landlord. What is the security deposit? What is the lock-in? What is the notice period? If they delay rent, what is the penalty that they'll have to pay? So we look at all these things, and then we finally come to the, only if all these parameters meet, we finally decide to put an offer. So then it comes to pricing, and in terms of pricing, we will study the capital value and the rental value of each and every other transaction that's happened in that building and in that market, and ensure that the offer we put is below the average of the market. So then we are picking up something below the market value or the market average. And all this data we get from public sources. Every rental agreement and sale transaction is registered with the government, and it's public information. So we pull that data out and examine that data before acquiring any property. So sorry, that's just on the commercial side. Of the other, obviously, very important piece is the legal due diligence, to make sure that the title is clear. So there we work with tier one law firms. We work with Shardul Amarchand Mangaldas, Cyril, Trilegal, to make sure there's no issue with the title of the property, and that effectively limits your downside risk. So at least you ultimately, there's no claim on the property. You are the whole and sole owner of the property. The person you're buying it from has the rights to sell it, and there's no other claim on the property.
See, there are two types of commercial real estate developers today. One are the DLFs and the Hiranandanis, who are established big names in the market. But there are also a whole lot of middle level and lower level developers who have understood very well that if the property is grade A premium, the prospects are very good, right? And instead of selling it piecemeal, they hang on to it, get it tenanted well. Which is the category of developer that you aim for?
Yeah, so I think what you said is right. There are, I would actually say, there are overall, in a sense, there are maybe three. Let's just say simplistically, there are three categories of developers. One is the top ones that you put it, like a DLF, a Hiranandani, an embassy. Number two are the mid-sized developers who still, are good, credible mid-sized developers who are building, good buildings. They have good track records. And other developers who have a few projects under their belt. They're not really known. They might be known in their micro market. Now, from a commercial real estate perspective, I think it's very tough for the third category of developers to even play in that game. They play more on the residential real estate game, and the reason being is you need a much stronger balance sheet to be a commercial real estate developer than a residential real estate developer. And reason being is, here you need that holding power or capacity to build the full building, rent it out, and then exit. While people who don't have a strong balance sheet go to resi real estate, because initially only you can start selling to customers, make put that money back into constructing the project. So number three developers, the category of three, won't even be present in they won't even have commercial real estate assets of grade A quality that are rented out. uh, Category one and two developers, we definitely do look at. Number one, in the category top category of developers, maybe the opportunities or the options that they give are a little bit lesser, because they are anyways, like say Embassy has their own REIT that they've listed, so they've exited that way. But sure, we in fact have discussed Embassy with some of their other assets. So depending on their situation, they may or may not want to enter the sell their asset to the REIT, so they might look to exit through us. But even in terms of category two developers, these are everything barring the top five developers in the country we are dealing with. So some very very good names like Kanakya, Ajmera is listed, Ashar, which is this latest asset that we're doing, Vaswani in Bangalore. In fact, to talk about a tier one developer, the asset that we did recently in Pune, where Microsoft was a tenant, it was taken from the development of K Raheja. So 75% of the asset is actually in the REIT. and we've bought in one asset in that larger campus and put it into our platform.
Why would they do that? Why would they not put everything in their own REIT?
So what happened? I mean, to talk about specifically that development. This is Commerce Zone Yerwada. It's a large campus. I think 8 or 10 buildings. And I think initially, when K Raheja probably bought that land and initially started developing, they I think they sold 25% of the overall project to investors. So again, at that time, they sold 25% of those project to ultra HN investors, which we bought it from. So even as someone like K Raheja, who's extremely solid, at some point in their journey they weren't able to hold on to the full asset, and they needed some liquidity at that point.
And who are your investors today? I mean, you said first you started with 25 lakh. Today, what is the ticket size and who are your investors today?
Yeah, so now with the SEBI regulation coming in, the minimum ticket size threshold benchmark has been set at 10 lakh. Uh, in terms of who are our investors, I mean, the easy answer is anyone who wants to put in 10 lakh, but it's a little bit more than that. Our investors are, for the most part, mid to senior level executives at good MNCs, large Indian corporates, white collar professionals who are probably making a salary of 30, 40 lakh a year minimum, lawyers, chartered accountants, doctors, military personnel, and then obviously a few business owners as well. So this is for the most part our category of investors, and geographically, like I mentioned, they come from across.
And when they put 10 lakhs with you, I'm trying to understand the commercials of it. Why would they come to a fractional ownership? Why wouldn't they go to a REITs? Why would they put it in real estate? Why wouldn't they put it, say, in a SIP? What is the difference in all this? And how do you bring them in?
Yeah. So first, I'll talk about why real estate versus not, and then I'll talk about REIT versus us. So in terms of why real estate or not, right? And real estate, I'm talking about constructed assets that are rented out. One is Indians still tend to love real estate. If you look at the numbers, 50% of Indians' net worth that's not their primary residence is invested in real estate still. Traditionally, it would be a second apartment or some land or something somewhere, depending on each individual. Now, I'm not saying you don't put it in SIP. I'm not saying you don't put it in mutual fund. I'm not saying you don't put it in FD. It's obviously a diversification. So people tend to put 20, 30, 40, 50% of their this thing in fractional ownership. The benefits are obviously you're getting a very stable return, right? You're getting a monthly income of 8 to 9%, which a lot of products don't offer. Even your, say you put it in the stock market, dividends will be 2-3% max. Here, and FDs give you 6-7% maybe. So you're getting 8 to 9% over here. Plus, you get the appreciation about 5-7%. So you'll make a 15% IRR. Sure, in the mutual fund or the stock market, you can make 20-25% return. So it would be higher than this. Year you would not make 25%. I won't even say that. But then your downside risk is limited. You're not going to go to zero. You're owning a hard asset. Your principal is safe. This October, there was a drawdown in the market. So some people would have lost 10% of their net worth. Here you sleep well at night knowing it's a hard asset. Downside risk is still limited. So this is a blend between a debt and an equity instrument. And so there's that certain, it's a diversification play, and it's a very stable investment with a good upside potential. Coming to compared to REITs, yes, underlying asset is the same. It's a commercial asset that's rented out. The difference I'd say is kind of two major differences. One is here you're picking and choosing which asset you want to invest in. In a REIT, you're putting in a basket of maybe 20-30 assets with 400 different tenants. So your upside potential is higher here. Obviously, there's a little bit more downside potential because it's one asset. But on the flip side, there's also the psychological comfort that we've seen with our investors investing in one asset. They're saying, okay, this is the property. I've studied the tenant. I've seen the leave and license agreement. I know this market. I'm a 1% owner in this building. I've done my research. That ability of one individual who this is not his full-time job to invest in properties, to understand what he's investing in is much higher. Because you can just understand, okay, this is the property, I drove by it, I know this tenant, I've seen the agreement, I've seen the title report. In a REIT, I'm not going to study 400 different tenants to really know what the right price of the REIT is. Here it's very easy for someone to grasp ki, am I buying it for the right price or not. So that's one reason. Other reason is and this is more how REITs have evolved in India. If you look at the four REITs today that are listed, uh, the developers themselves have sold their assets into the REIT. So have they sold it for the best price for the investor? Because they are also liquidating themselves. Here we are not putting any of our assets, we are taking completely third party assets, so we are negotiating extremely hard with the seller of the asset to get the best price. So those are kind of the two nuances, but obviously underlying asset class is still the same.
And how long would you hold on to these assets? Would you hold on to them forever when you see the market cycle changing? Would you then start exiting that property? How does it work?
Generally we look to hold on to about 4 to 6 years. In that time period we look to start exiting the assets. Obviously, we'll get a good deal at that point, we'll exit. Otherwise investors can exit their share on the platform at any point in time that they want. So far, we've anyone who's wanted to exit, we facilitate an exit. It takes about 30 odd days, and then one is able to get an.
You started in 2019. Let's take, say, 2026 to 29. Maybe you will start exiting, or you will think of start exiting, right? Let's assume there are 10 buyers in that property, 10 investors in that property. What happens to them when you start exiting?
So we'll exit. So we'll give an exit to all those 10 investors, and they'll get their appreciation. They can reinvest in one of our other properties that we've come up with.
One more question. Suppose, fractional ownership rules have been framed by SEBI quite recently, right? It has worked without any rules, and it has been a struggle. How is the structuring of the policy framework helped you?
Yeah, I think I mean, I'll talk a little bit about the journey, but I think firstly, just I think SEBI's done an amazing job. So they called us in about 2 years ago in 2022, and they wanted to understand what's going on, how it works, and would we be open to regulation. At that point, as I'm saying now, absolutely, it's great to work under the SEBI umbrella. So we put in at that point, we created what we think the regulation should look like, sent it to them. In May, they came up with a consultation paper. Last May, sorry, May 2023. They got about 70 responses. In November, the board of SEBI approved the SM REIT framework, and in this March, the detailed notification of the SM REIT regulation came out. So it's extremely positive. We should be kind of getting our license any point in time now and listing our first asset on the SM REIT pretty soon. And we'll be looking to migrate all our past assets under this SM REIT. And I think the benefits are great, right? Because now you have you get units which are listed. You can trade those to other investors for liquidity increases, and you're getting SEBI oversight. Anyways, what we were doing in terms of transparency compliance was anyways to the level that SEBI requires, but now we get the SEBI stamp, so it's great for us. I think it's great for the investor because they have comfort that if something goes wrong, they can go to SEBI.
When you migrate to a SM REIT, SM REIT is typically below 50 crore, right?
No, SM REIT is between 50 and 500 crore assets of between.
So you are only people who are big enough with 50 crore worth of assets start with it. So a lot of fractional ownership people would have been ready, getting ready for SM REITs, right?
Yes, yes. I think a lot of players will start migrating.
Now, earlier there were very few fractional ownership entities. Today, it's a rather crowded market, right? More and more people are coming in. How does that impact your ability to get the best?
I would say that, to be honest, in the say, like if I talk about commercial fractional ownership, right? I'm not talking about villas, which is a different market because that's more a use case. I'm not talking about fractional ownership of other asset class. I'm talking about commercial real estate, which is office, malls, hospitals, warehouses. And I'm not talking about under construction assets. I'm talking about constructed assets. There, to be honest, there are just three sizable players, us being one of them. And I feel like now we've established a good name in the market, both from a developer perspective. So a developer knows that we'll fund their asset in a specific period of time. From an investor perspective, now they see our track record, assets that we've done. So obviously there is competition. There always will be competition. I think that's a good thing. That's a good thing for the investor because the investor has choice. In the same way, in the mutual fund industry, there are multiple mutual fund AMCs and managers. An investor has choice. That's always good for the investor. That's good for us because it makes us evolve into be a robust business and make sure we get the best opportunities for investors. On the flip side, it's not like um, there's no there's not a dearth of assets in the market. Obviously, you have to pick and choose and select good assets at the right price. But there's 800 million square feet of grade A offices in India, which is about 8 lakh crore worth of offices. And the three office REITs, the market cap is only 55-60,000 crore. Say the likes of DLF, like you mentioned, maybe they will not sell into the SM REIT. Maybe that's overall 2 lakh crore. That's still 6 lakh crore worth of grade A assets that need an exit option, where we and the other players do come.
You talked about Delhi, Gurgaon, Mumbai, and Bangalore. Is there a specific sector that you're looking at? Are you looking at properties that are driven by, say, BFSI or IT? What drives you to pick up one property and not?
No, I think so. Overall, if I just say offices, and we are looking more than offices as well, but office would be maybe 75% of our business. So offices, they are the basically the grade A offices and the top six cities: Mumbai, NCR, Pune, Bangalore, Hyderabad, Chennai. What drives this? I think there are multiple sectors. They're all extremely attractive. Whether it's BFSI, now there's a great GCC boom that's happening in India, and that's a continuation of what's been going on since say 2000, when the outsourcing started into India. I think what's happened now, though, there are multiple factors which is leading to this just growing further and further. And I'll just talk about a few of them in terms of GCCs, right? So GCCs is global capability centers. It's these large MNCs, etc., that are offshoring into India and having manpower in India. So earlier it started just by the simple BPO kind of call center, service center. Then you had IT services. What's happening now is, as Indian talent has gotten more and more evolved, more educated, more experienced, more and more value add services. So India is slowly moving not just from back office of the world, but more and more front office kind of roles are also moving into India. That's number one. I think number two, what has happened during COVID is a lot of these American headquartered companies, and I think about 70% of office real estate is occupied by non-Indian headquartered companies. Um, so during COVID, a lot of these American headquartered companies saying, okay, if people are working from home, might as well work from India. And so a lot of the jobs have further moved to India. The third thing is and this is pre-COVID as well, been going on for the last 10-15 years, the rupee to dollar depreciation. So if I look at, I think in 2010, the rupee to dollar was 40. Now it's about 80. So while the rents have risen for Indian landlords, for an American headquartered company, even though the rents are rising, because the dollar is appreciating as a rupee, for them on a per square feet rate, dollar per square feet rate, the rate in India hasn't really changed. So, from a office market, for exporting the office market to the rest of the world, this dollar depreciation has helped India significantly in this way. So overall, I think India will continue to be the back office destination of the world. There are multiple reports saying the level it's going to get to, and then overall kind of office market in India is smaller than kind of the New York area in the US. So the growth potential is amazing.
And you talked about the institutional market, hospitals, warehousing, and so on. How are they performing? I think that they were in the beginning of their journey, right?
Yeah, I think they are a little bit more younger in terms of market, right? In the recent past few years, we've seen hospitals consolidating, and now you have these professional hospitals like, say, Max, Fortis, Apollo, Manipal. So now you have these large chains that are great organizations, and they'll need long-term leases for their hospitals. You have large schools coming up. 20 years ago, you didn't have these kind of large schools, chains or hospital chains. Warehousing has picked up tremendously post the e-commerce boom in India. Right? I think across these sectors, we won't only just look at tier one. We'll also look at tier two cities, because while office people are migrating into these few cities for business, there are the requirement for schools, hospitals, and warehousing, and the consumption story is happening pan India, not just in the tier one cities. So Ahmedabad, Indore, Jaipur, all these cities are cities that we could look at. The other thing that over and above hospitals, schools, and this thing that we missed out is malls, retail. Retail is also performing extremely well. and it's back with a bang post COVID.
Is it only malls or high street retail also? Like high street kind of type of retail which is coming up?
That's a good question. I think that's limited to a certain locations in certain cities. So there is a certain demand for it, but I don't think the volume is as large as some of these other asset classes.
Well, the reason why I asked is Khan Market featured in the top 20, Galleria featured in the top Asia Pac.
No, absolutely. So there are a few places like these, and primarily in your Mumbai, Delhi's, and Bangalore's. I don't know how present they are in kind of tier two cities.
And as an investor, when I come to you, would I pick up in institutional or would I pick up in commercial? Is there a differential in terms of return?
No, I think, I mean, as an investor, you have the choice as to what you want to invest in. Now, what you should invest in, I think, is less to do with, okay, should I invest overall in offices or overall in warehouses or overall in schools? I think it has to do more with that specific investment. Who's a tenant, what is the lock in, what is the rationale for that tenant being there, what is the appreciation that's expected in that market. And that is unrelated of whether it's an office in that market or a school in that market or a warehouse which will be a little bit more on the outskirts. So I think there obviously, and the high level though, on an average the return profiles are relatively similar. You get 8 to 9% rental yield and you get about a 15% IRR. So on average it's relatively the same. Then you have to pick and choose the specific investment opportunity.
Do you guarantee that 8 to 9% and 15% overall?
So 8 to 9% is based on the contracts that are there with the tenants, and these are long-term contracts. The IRR obviously is subject. It could be 5 years, it could be 9 years, depends on the that specific deal. And the IRR obviously is subject to the appreciation, which is subject to the market. But we provide rationale in the then investment why we expect that IRR. And it's a combination of picking it up at a good price below market, as well as kind of infra developments that are happening in that micro market. So that's how we look at it.
How significant are infra developments? Suppose there's an infra that is announced, and you know that typically infra can get delayed in the Indian context. So something that you expected would happen in the next 6 years, if it doesn't happen, does that impact your investment?
Yes, it does if it doesn't happen. And that's why when you look at, say, 6 years down the line, infra development, that's too long term for us to take that call. But I'll give you an example, right? We picked up an asset in Mumbai and Andheri, where Metro Line 3, and Metro Line 3 is kind of the main metro line. Now there was, which is going through airport, through BKC, through Lower Parel. Now the station was already under construction, and this we picked up in 2021. Station was already under construction, and this was about a few hundred meters away from the office that we picked it up at. Now there we had pretty good certainty that it's going to come up. Now whether it'll take 2 years, whether it'll take 3 years, or it'll take 3.5 years, we were not sure. And even as of now, that Mumbai Metro Line 3 is operational. Only half of it is operational. The other half is not operational. But this is within a 2 to 3 to 4 year holding period. So it's within that period. We're not looking to sell it in that 3 to 4 year period. So if it happens in 2 years or 4 years, we're fine. So that's kind of the call we'll take. A little bit more longer term, and that I agree, it does become a little bit more risky to take that play, because then you might be exiting the asset and then infra development would have still not happened. But now I think I can say with a 95% certainty Mumbai Metro Line 3 will be operational by next year, because half of it is already operational.
But in Bangalore, you can't say it will definitely be operational in 6 years.
Yeah, true. But now what has happened is the metro into Whitefield has now started, and that has increased the price. Now, yes, people have been hoping for that for years, and now it finally happened. But yeah, it's very tough. It is tough to predict when infra development is going to finally happen.
Have returns changed over the years? From, let's say, from 2019 to 2024, have you seen the returns changing, the rate of returns changing?
I haven't. So in offices, no. Uh, and I'll tell you, and I'll come back to offices, but in warehouses, yes. Warehouses used to be at like about 10%, 9%. Now it's gone to 6, 7%, because I think it's a very overheated market. So it has, returns have gone down in warehouse. More and more capital and investment has come in. In offices, it's kind of been 8 to 9% in the last 5 years. Prior to that, it was higher, but last 5, 6 years, it has been 8 to 9%. Though what has happened is that over the last 5 6 years, the availability of deals, of good deals, would fluctuate based on where we were in the cycle. So when kind of interest rates were high, we were getting a lot more deals and good deals at 8 to 9%. When interest rates are low, those good deals kind of dried up because the developer then didn't need to sell, his interest burden got lower, and that's when kind of the good deals went away. So, and that's kind of why we're very bullish right now, because right now we're at the peak. RBI hasn't started cutting yet. The US Fed has had a few cuts, but I think if we pick up a lot now, then I think if over the next 1 year interest rates come down, you might get find it harder to get deals, and it does take time generally from RBI cutting rates to it percolating into the real estate market. There's kind of a 6 month to 1 year lag until people start feeling the pinch. Either way, either the pinch or the benefit.
Is there anything else by way of policy that you're looking forward to? Is there anything in the works that will impact your income?
I think, see, this SM REIT policy obviously is great. And even after the policy has come into play, SEBI has been extremely proactive, both in terms of disseminating what's going on. So they've had multiple seminars in Mumbai, Bangalore, Delhi, talking about what the policy is. And they're extremely receptive in taking the feedback of market participants. So something that they've done, they put out a consultation paper again on October 30th or 31st, which is basically the actual IPO process needed to be streamlined a little bit. So they've kind of again they had a working committee, they've streamlined it. So it's not some new large policy change, but just tweaking currently what's there, and that's they're learning a little bit more from what is required for the market, and they are being very proactive about it. So I think overall it's moving in absolutely the right direction in terms of policy.
Thank you so much for joining us. I think it's a subject where there's intense investor interest, intense financial sector interest, and of course, experts like yourselves. So, thank you so much for joining us. Found this video useful? Please subscribe to this channel for more such videos. Do like and share with as many people as you can.